Morgan and Pierre, welcome to the show.
Hi, Steve. Thanks for having us on.
Yeah, we're excited to be here.
Well, I'd like to call you two the first couple of crypto. Would that be a fair, a fair description?
Of Bitcoin. Let's
Of,
leave it at that.
of-
We can
Yeah.
talk about that.
there you go. That's right. The first couple of Bitcoin. Got it. Excellent. All right. Well, where I want to start today is just really talking about where we're at with the economy. And particularly, we've got all this money printing going on. And let's say we go back to the Great Recession back in 2007, 8, and 9, really started putting on the accelerator in terms of the Fed putting a lot more money into the economy. Now we've got the Biden administration that is talking about a $2 trillion plan, and maybe that's just a down payment for what's to come. And so I know there's a lot of concern out there about what that means. And I know both of you in particular have, I think, some strong opinions on what that means and how that impacts Bitcoin and where this is all going to lead. And so I'd like to just start there. And I think I'll start with you, Morgan, in terms of what are your thoughts in terms of where we're at with the monetary system here, and what do you think are the implications with all this trillions of dollars that's being put into the economy right now?
Yeah, I mean, I think the thing to start with is that we don't really know. And I think that that's why people are looking for other asset classes in particular to help them sort out just the vastness of the money printing, what that means for the future, what that means in the near-term future, and what that means over the long-term future for people. We've never really been in a situation where governments have just printed money to whatever end that they feel necessary. And that's kind of where I feel like we are. I mean, I think when the 2008 crisis happened, it felt like maybe it was just limited to that, and that it was something that we can move forward from. And the amount of debt that we had at the time was something that was actually manageable. But then, they continually raised debt ceilings. They made no effort to try even to pay it back. And then future disasters happened. And the first thing that they turned to was the money printer. So it seems to me that if we're constantly in cycles where, we go through a boom and a bust, and we can get into why maybe modern monetary theory has something to do with that. And, having an inflationary monetary policy has something to do with that to begin with. But the more we can't really tolerate busts anymore is what it seems like, or the government doesn't want the people to tolerate busts. And so what they've done is they've decided to print money instead, to put money in the pocket of the people, but it isn't really what's happened, right? What's happened is that there's just been asset inflation, and they're claiming that there's no inflation, but yet, like when I go to the store, I see it. And I feel that even when I go buy anything, any service, any good, that I'm being anchored to a new higher price, even though I'm being constantly told that there's no inflation. So to me, it seems like of course, people are looking for something else. Of course, people are looking for an answer to something where maybe there's a limit to what people, what governments can do.
Yeah, and Pierre, I know you have some strong feelings on this as well. I've listened to a number of the podcasts that you've been a guest on. So what would you like to add from what Morgan just said?
Yeah, I agree with that. And really, governments are in a position where they have to print money. They don't have another option. And the reason that they have to do that is that there's a cash shortage in the economy. And when I say cash, I don't literally mean like physical paper or $100 bills. I mean cash from an accounting perspective of liquidity on your balance sheet, whether it's held in a bank or in a central bank. And we have to look at why there's a cash shortage, right? So that we can find the root cause. Because when we address a cash shortage by just creating more, we're treating the symptom of the problem rather than the root cause. And so when we look at the kind of financial advice that folks get, Ray Dalio has famously said, cash is trash. Right? CFAs talk about how portfolios have cash drag. So the more cash you have, the worse your portfolio is going to perform. And financial planners tell their clients, hold as little cash as you can, maybe just 6 months worth of expenses. don't hold, 2 or 5 years worth of expenses in cash. And so why is this advice commonly, held, and why is it correct? Well, it's correct because cash is subject to dilution and to inflation. And so if you hold too much cash, then you're not earning a yield. And in fact, you're subject to a negative yield of whatever the inflation rate is. Now, Morgan mentioned that, inflation, we're told, is 2%. It doesn't really feel that way. And the reason it doesn't feel that way is that in CPI, consumer price inflation, is an objective measure, right, done by the Bureau of Labor and Statistics. But in reality, in our day-to-day lives, inflation is actually subjective. So your personal inflation rate is going to depend on the set of goods and services that you are buying in the market, not the basket of goods and services determined by BLS in Washington, D.C., right? And so, for example, if you are very, maybe you are a vegan, and so you don't eat any meat. If meat prices go up, you don't see that. That's not inflation for you. If you're a carnivore and you only eat beef and beef prices go up 20%, you just had 20% inflation. Even if BLS says, hey, look, these soy burgers, they actually only went up 2%. That's not really relevant to you because that's not in your basket of goods. And it's also true for investors. So investors are purchasing investment assets, like real estate, like stocks, like bonds. And the BLS, specifically measures consumer price inflation. They don't measure investor price inflation. And so if PE ratios go from 10 to 20, that means that, prices doubled, right, for those investment assets. And that's not captured by CPI. So all this to say that the reason people hold as little cash as possible is because they want to be either in investment assets or they want to be consuming, right? And it's kind of the deliberate policy of inflation is to incentivize people to spend their money as quickly as possible or to invest it as quickly as possible. And in order to accelerate economic growth. So that's a noble goal. It has the unintended side effect that there's too little cash being held by people. And so then we get into a situation, well, let's go back to first principles. Why do people hold cash? It's to hedge uncertain future cash flows, right? So if you knew all of your future cash flows with total certainty, you wouldn't need to hold cash because you could time all of your cash flows to coincide with one another, and then you could hold zero cash. Now, in the real world, not only is there uncertainty, but sometimes it feels like there's increasing uncertainty. And so people hold more cash when there's an increase in uncertainty, and then they hold less when there's a decrease in uncertainty. So with inflation, people hold too little cash relative to how much uncertainty actually exists. And instead they use, for example, they might use low-cost index funds as their hedge against future uncertainty. So they will sell their S&P 500 shares if they need that cash in the future. And so they're depending on liquidity of other assets other than cash. And so in 08, we saw this become a big problem, and then governments printed money to and then distribute it. And one of the issues with that distribution is that it would be great if they were able to target who gets the cash in such a way that only people who happen to have too little cash and who just need kind of instant liquidity find that relief, and then they're able to pay it back. And so then we don't have, new money circulating. Instead, it's just a timing difference. But the reality is that policymakers don't have that tool available to them. The tool they have available to them is that they can go and buy bonds in the bond market or they can provide more cash to commercial banks. But that's kind of like pushing on a string, right? Because commercial banks and the bond market aren't necessarily where the cash shortages are happening. It's happening with households, with small businesses. And so we saw with the COVID relief, the huge problem was, how do we get cash into the hands of people who actually need it today, this month, next week, right? And there's just not a satisfactory policy mechanism for doing that. And it has caused massive political polarization and antagonism, where we see some people receive lots of cash, right? So, for example, ultra high net worth investors had no problem getting cash through the crisis, right? They have large bond portfolios. They can go borrow against that. They don't have any issues. Someone who just owns a restaurant, which is very illiquid as an asset, they're struggling, to get their PPE loan from Chase, right, or from any commercial bank, and they're filling out all this paperwork. They don't have an army of lawyers and accountants to take care of this for them. They're a small business owner running on thin margins, and so when they see this massive inequality in the policy response, it's entirely understandable that they would, get angry and frustrated. And it shows why the idea of, well, it's okay for the economy to run with very low cash balances because we can bail everyone out when there's a crisis, that sounds good in theory. But in practice, it actually drives massive wealth inequality, and it causes massive redistribution of resources, real resources, from the bottom to the top.
What do you think is the root problem here? So you said there's a shortage of cash, and we're treating the symptom here. What are you saying is the root problem that we're not really addressing yet?
It's the inflation. It's
inflation.
that we are punishing people for holding cash. We should actually be rewarding people for holding cash with deflation, so that their purchasing power of their cash is increasing over time. And that would incentivize them to not just hold 6 months worth of expenses, but, much more than that. And
I think it also aligns with how people like to make decisions. So people don't like to be forced into very quick decision-making processes. And when you know that your cash is depleting in value, you're either forced to quickly spend it or quickly invest it. And we're not really supposed to be doing either. It's something I talk about with clients all the time. It's like, if you feel like you're spending too much on Amazon, put something in your cart and come back in 3 days, and then see if you still want it 3 days later, right?
And you'll get an email from Amazon saying it's 10% off additional if you complete your cart purchase.
Same thing with investing, right? Like, we shouldn't be making half-hour investment decisions because we don't have the time, right? We should be in a position where we're able to hold cash and we're able to wait for opportunities maybe, and we're able to really think about our situation on a whole and then make the decision as to how we want to invest, and not be forced to invest and basically forced to use the stock market as emergency savings, which is what is happening and what I've really seen happen with my clients over the year. I mean, we tend to, you can't really hold bonds anymore. They're not really yielding anything. We're kind of in a place where people are being forced to invest on really the upper echelon of their risk tolerance. And I mean, and then we're surprised when people start selling off assets during a crisis.
Mm-hmm. So this inflation thing, obviously that's a big issue. And I think, Morgan, you may have mentioned Stephanie Kelton here, or MMT, a little bit earlier. I actually had a conversation with her for about an hour here a few days ago for a podcast, and have spent a lot of time researching MMT. And I'm sure both of you have strong opinions on that as well. So I'm sure we'll touch on that here over the course of the conversation. And one of the key parts of MMT, of course, is, we can put more money into the economy because we have a sovereign currency. And as long as we keep inflation under control, we're going to be okay. And for the past, more than a decade here in the US, by the measure of CPI, inflation's under control. But like you two were saying, inflation's personal. It's like my inflation based on the basket of goods that I buy, it might be going up 10 or 20% relative to someone else. So we can certainly say that, maybe inflation, CPI is not exactly capturing it for everybody. But in your ideal scenario for either one of you, is your ideal scenario that we have deflation, or is it that we just have pure stable prices? We have neither inflation nor deflation.
My view is that deflation is good, and that we should want deflation, and that even preventing deflation, right, and having stable prices, that is also disincentivizing people from holding cash. And so we should be trying to incentivize people to hold as much cash as possible. And that's the direction we should be going in. Now, how much deflation would happen, it's going to depend on people's preferences, right? And that's what I think it comes back down to, is that it should depend on what individuals and businesses are seeing in the market, rather than depending on bureaucrats in Washington, D.C., trying to top down control the economy. And really, the counter argument that you'll hear is that, well, if we don't have inflation, or if we have deflation, then people won't go consume, or they won't invest. And I think the fallacy there is that people don't naturally want to consume. I think the total opposite is true. People love consuming. They love it. I haven't met
incentivized to consume.
I'll grant that there are a few monks, who are trying to live a life without any material goods, but those are few and far in between. The vast majority of people around the world, the reason they want to consume is because of Maslow's hierarchy of needs, right? They want a nicer house to put their family in. Of course, they want a pool. They want to have good food. They want to have a beautiful car. They want to have a safe car. They want to have the best education for their kids. People want to spend money. That doesn't need to be incentivized. And we've seen this in electronics, right? Where the price of electronics has rapidly decreased. So we've had hyper deflation in the world of electronics over the past 30 years, despite the monetary inflation, right? And the reason is because of Moore's law, right? Where we have been able to make advances in semiconductors at just an absolutely incredible pace. And yet we don't see people waiting to buy electronics until the next generation, because they know it's going to be 10 times better. They buy an iPhone today because they get immediate utility out of it. And so that's I think that's the fallacy on the consumption side. On the investment side, the fallacy is about returns, right? So people are incentivized to invest based on returns. So they want to either earn interest or capital gains or dividends. And so if an investment can't provide those things, then it's a bad investment, right? So creating inflation to push people into bad investments, that's what led to the subprime mortgage crisis, right? So folks think that if we have inflation, then we'll see more investment. And that the problem is that there's only so many investment opportunities of quality out there. And once those have been saturated, and they quickly get saturated because people want to make money, right? They want to have profitable investments. Then any additional cash going into the investment world is just driving up valuations, and thus driving down expected returns, right? So when we drive the stock market up to like 50 PE, when there's no growth, then we know that we're driving down future returns. And so it's the same thing with negative interest rates in the bond market. And so there's not really a reason why we should want to incentivize investment, because there's already a baked-in incentive to make money, to earn a return. And punishing people for holding cash only leads them to making bad investments, not to making more investments.
I think though, the other thing about deflation though is we kind of get anchored around pricing in general. So if there were deflation, let's say we had a deflationary world where it was 3% a year, people would get accustomed to earning 3% a year, and then they would go seek out something more than that because they're like, well, I want more than 3% a year. I think it's kind of just the human way of dealing with things. It's the same thing of why, even though, I mean, we live in an inflationary environment right now, but why people maybe weren't that excited to earn 3% on their cash back in 2008, even though now 3% on your cash would be like the most exciting thing in the world. And it's because we get anchored around certain pricing and then we seek more.
Well, we had deflation back in the Great Depression. That wasn't all that great, I don't think. We had deflation or well, probably not right now in Japan, but there was certainly a period of time not that long ago where Japan had deflation. So what's the good that comes out of it? Let's go to the Great Depression here in the U.S. with the deflation for a number of years. How does that square with what you're talking about here?
Yeah, so we have to look at the economic context because there have been different phases of deflation. So if we look at under the gold standard, what we had was a system where we had fiat money that was pegged to certain exchange rates, fixed exchange rates to gold and sometimes to silver as well. And what we would see back in the day is that we would have banks create that fiat money. And then when they had stretched themselves thin and people were withdrawing gold, in order to maintain that exchange rate, that fixed exchange rate between gold and fiat money, they had to liquidate assets. And so you, in this fractional reserve system, you had a series of booms and busts. In the US, they were related to land and then to railroads. And then in the 1920s, it was related to kind of the new wave of manufacturing that was happening. And on top of that, you had the post-World War I monetary expansion. And so you had a decade of monetary expansion from 1920, or well, really 1918 to 1929. And then you had a deflationary period due to Federal Reserve monetary policy, where the Federal Reserve tightened monetary conditions. Now, it goes back to what we were initially saying, is that when you have an inflationary system, you have to print money to continuously bail it out. And if you don't do that, then the inflationary system collapses on itself and you get a Great Depression. Now, the problem is that you have set inflationary expectations in the economy. If you set deflationary expectations, then you don't have a buildup of fiat-denominated liabilities that ultimately do need to get paid, because then people don't take on as much debt. Right. So if you know that the value of money is going to be increasing, you're not going to take out a loan in that money, and vice versa. So in the inflationary system, it makes a lot of sense to take out a 30-year mortgage, at a 2.5% interest rate. If you're doing the math of, well, let's say inflation is 2%. Then okay, 0.5% interest rate on your mortgage.
Why not a 50-year mortgage?
Yeah, why not a 50-year mortgage? And then if the monetary system breaks those expectations by doing deflation, well, now your 2.5 interest rate, that, let's say there's 5% deflation, it suddenly becomes 7.5% interest rate, and you might not be able to make those payments. And what happens in the fractional reserve banking system is that if you can't make those mortgage payments, those debts go bad, right? And we saw that happen in 2008. And so that's why you have to have continuous bailouts when you have inflation expectations set at 2%. Now, so I'm not saying that we should cause those problems by not bailing out the system. I'm saying we should change the inflation expectations, and how we transition from one system to the other, in my mind, is Bitcoin. So we can talk about how that transition happens.
Okay, well, that's exactly where I wanted to go in terms of how do we make that transition. So if the expectation is we're in an inflationary economic system, which we are, and in talking to Kelton a few days ago, I mean, she didn't come up with this, but a lot of central banks around the world say we're targeting about 2% inflation per year. And if the idea is, I think there's a lot of people, probably you too, would suggest that if we continue on the path that we're on, if we continue to print trillions of dollars, central banks around the world and treasuries around the world, at some point, something's going to explode. Something is going to implode. And that to me is the big question. And that's why I'm doing this podcast is, what is that? Is that going to happen? If it does, how do we anticipate it? And how do we prepare ourselves for that, both as individuals and also as financial professionals? How do we prepare our clients for that? And so you just said Bitcoin here. So before we start diving into that a bit, tell me how you think this transition starts to happen. What are the warning signs where, oh my gosh, this is going to crash here?
Oh, do you want to? I'll pop in a little bit and then you can add to me. Yeah. So in my mind, I mean, the way that it ends is when people don't want to hold dollars anymore. And I think people often think, so I don't think we actually have a problem until people decide that they don't want to hold dollars anymore.
Okay. But if they say, I don't want to hold dollars, they've got to hold something. And and you're saying, okay, it's probably going to be Bitcoin. But for a lot of people, if they say, I don't want to hold dollars, if the dollar's declining in value, that means something else is increasing in value because it has to be relative to something else. So if it's not the dollar, and if it's kind of Bitcoinization, hyper Bitcoinization, is it something else? Tell me about that.
That's a great question. I mean, the thing is though, right, is that there's not really any difference between the US dollar and what's going on in other currencies around the world. Everyone's printing. So in my mind, it's not really a question of, oh, do we go from the dollar to the euro or do we go from the dollar to the yuan? It's more of a question of, at some point, people are going to be frustrated with the idea of fiat currencies and they're just not going to want to use them anymore. And I think, I mean, we probably differ on this, but I think it's going to be a pretty gradual process that people don't even realize is happening until they wake up one day and it feels like it's an explosion and now everyone's using Bitcoin or whatever it is that we choose to use, but we both believe it'll be Bitcoin. But yeah, I mean, it's already happening, right? Because companies are now starting to hold Bitcoin on their balance sheet. MicroStrategy just issued convertible debt to buy Bitcoin. So like the first little seeds are being planted and people are not really aware of it, but like this process is already starting.
Yeah, on your point about kind of what's the end game for the fiat system? So we have to look at kind of what has been the evolution. So the first thing that happened is that checking accounts and savings accounts at banks became monetized. Before, it used to be the case that if you deposited dollars at a bank, you're lending them that money at your own peril, right? If the bank goes under, then you get wiped out. And so then you would have to do your due diligence and make sure that they are creditworthy. What the FDIC did is that they monetized bank accounts and said, hey, look, dollars at a bank are just as good as dollars in your wallet, up to 100,000 or whatever the limit is.
So the insurance,
wow,
so they're insuring it. They're saying we're going to backstop it if there's some criminal activity here.
Now, well, criminal or not necessarily criminal, right? Just economic, right?
They decisions and
insurance is a misnomer in this case because it's not an actually insurable risk, right? There's no actuaries who are doing running the numbers on this. It's much like government provided flood quote unquote insurance, where it's really about redistributing wealth and redistributing uncertainty. There's no actuarial risk here, and that's why there's no private insurance for bank deposits, or that didn't exist before the FDIC. It's not an insurable risk, so what they did is that they monetized bank deposits, and then the next step was they monetized money market funds. So it used to be the case that a money market fund could break the buck, right? Where they were worth less than $1, and they plugged that hole in 2008. And now I would argue that they have monetized the whole treasury market, right? So treasuries, and that's what Stephanie Kelton's point is about MMT and the deficit myth, is that the myth is that treasuries are debt. The reality is that treasuries are money because they've been monetized, and so it's just a yield generating, or I'm assuming it's positive, but dollar. The financial system uses treasuries as cash, right? If you talk with an accountant, they'll tell you, yeah, short-term treasuries are a cash equivalent. And when you put it on your balance sheet, according to US GAAP, it's a cash equivalent. And so it really shows that these assets have been fully monetized. And so they are seen as cash by the private sector. The next step that we're seeing is, central banks have started buying corporate bonds. And so, through different facilities. And so the corporate
run out of government bonds to buy.
Yeah. Because governments are not creating enough government bonds. So they're monetizing corporate bonds. So corporate bonds now are becoming a form of cash in the financial system. And the next step after that is equities. So in Japan, for example, they have started buying equities. And, there's famously the Greenspan put, right? Which is that central banks have an implicit they're writing a put option on equities. And so if the stock market crashes by more than X%, then we know they're going to step in and provide enough funding for, and they do this, through intermediaries. So when a central bank buys bonds from a large portfolio manager, that portfolio manager, and bond prices are getting bid up, everyone starts rebalancing, right? And so that means that they sell bonds to the central bank and they go out and buy equities in the public markets. And so at this point, equity markets have become monetized. And as that put option gets exercised and central banks get put stock, what we'll see is that we essentially have a nationalization of capital markets, right? So all publicly traded securities, eventually, the end game is that they're owned by the government, and that way everything's been fully monetized and de-risked. Now, what are the consequences for the economic system? I'll leave that to the imagination of the listener, right? Do we believe in free market capitalism, or do we think that communism was effective in the Soviet Union? That's a political debate. I don't want to get into politics. I'm just describing what is happening and what will continue to happen.
Okay, so you kind of laid out a stair step here, the two of you, about how we start with checking accounts and then money markets and bonds, and then we go to equities, and essentially everything gets owned by the government to some extent. And so over that period of time, more and more people are going to realize what's going on. And so they're going to say, well, hey, maybe I need to have an alternative here that's not controlled by the government. And that's where Bitcoin comes in here. So let's talk about that.
Yeah. So, well, before we get to Bitcoin, there's a few other assets we could look at, right? We could look at real estate. We've seen real estate prices and valuations skyrocket as people use real estate as a store of value. And so like in New York City, in Manhattan, you have empty apartments, right, that are just being used as savings accounts by their owners. And
really causing issues though for the
normal people,
right? Because now they have extreme consumer price inflation and really the largest fixed expense, which is rent or their mortgage.
Right. So you've got real estate, you've got art, you've got all these other scarce assets that wealthy people like to purchase. So with this inflation that goes on and all this money printing ends up in the pockets of wealthy people, ends up in stock prices going up. You talk about stock prices. Well, anyway, we'll get to that later. But yeah, so we've got these other assets that are going up in value that are scarce assets that people feel that they're a store of value.
Yeah, that's right. And then lastly, Bitcoin, where it takes the same principle of, look, there's X amount of land on Manhattan Island, right? And so it's a scarce asset, and that means it's going to have a premium value because of its location. Now, with Bitcoin, there's only going to be 21 million Bitcoin, right? But the counter argument is that there's a lot of other cryptocurrencies. And so how is it that Bitcoin is scarce if you can go create your own cryptocurrency? And many have created their own cryptocurrency, right? There's no barrier to entry. You can put up a website and start it.
Or just fork Bitcoin itself, which has happened many times.
Which we've seen done. And the challenge there is that you've got to get other people to buy into it. And so there's this network effect of liquidity where you have to provide a really compelling argument for someone to hold one of these other cryptocurrencies instead of Bitcoin. And if we look at the market, right, what have been kind of the price signals we've seen, it's been very hard for other cryptocurrencies to sustainably accrue value versus Bitcoin. And we've seen Bitcoin throughout its life maintain a very strong lead in its liquidity, where it has 80% of the liquidity of all the cryptocurrencies. So why is that? One of the main reasons is that Bitcoin is very decentralized. So anyone can run a Bitcoin node. You can do it on your laptop, on your desktop computer. And what running that software allows you to do, you might have heard of Bitcoin mining. This is separate. Running a Bitcoin node allows you to verify that the Bitcoin miners are following the rules, that Bitcoin's monetary policy is being respected, and that when someone says they're sending you Bitcoin, that they're actually doing that. You don't have to trust them. You don't have to trust a third party. You're actually able to see it with your own eyes and using your own computer. And that second one of having a credible monetary policy, I think, is actually the most important in the context of our conversation about monetary economics, which is that because anyone can verify this 21 million Bitcoin, although right now it's 18 million, right? They're still coming into, but fully diluted, it's going to be 21 million.
Less the original 50 that can't be spent.
Less the original 50 that can't be spent. There's a few others that can't be spent.
That are lost.
Yeah. And that's okay. That's to the benefit of everyone else, right? And that's really appealing for folks who are looking for the scarcity of real estate or gold, of art, combined with the liquidity of a money, combined with the convenience of a digital transactional system that is operational 24/7, that is decentralized. And so you're not having to worry about, oh, is the bank closed or is this a federal holiday? You can send or receive your money anytime, any day, to anywhere in the world that has internet access.
Yeah, and if you compare that to real estate, I mean, I think when people use real estate as a store of value, they don't think about all of the transaction costs associated with actually getting their money out of real estate.
And the property taxes,
and the property
maintenance.
taxes, the maintenance, everything else that goes into it. There are certain things. I mean, even if you have an empty apartment in Manhattan that you're never using, you still pay property taxes on it. You still pay maintenance. There's still occasionally something that's going to break, even if you're not using it, that you're going to have to fix. And if you want to get money out of that asset, now you're either doing a cash out refinancing or doing a home equity loan, or actually physically selling the asset, which then has third parties involved that are going to take some money off the top. So, I mean, comparatively, when you think about that as a real asset, or even if you look at how you would have to use gold, it's a lot more difficult than what you would have to do to use Bitcoin.
And Pierre, I know you've pinned a tweet that says Bitcoin is the next world reserve currency. So let's talk about the practicality of that. And I'd love to get both of your opinions on this. So right now, the dollar is the world's reserve currency, and what, 70%-ish of the world's transactions are essentially happening in the US dollar. So if Bitcoin became the world's next reserve currency, does that mean that a huge percentage of all the transactions are going to happen in Bitcoin? Does that mean that we're going to be going to Starbucks and putting some Satoshis out to buy a cup of coffee? Or is there a dual system where Bitcoin is the reserve currency, it's the monetary standard, and maybe we've got other forms of money that we use to interface with the real world? Tell me a little bit about that.
Yeah, I think it certainly could be both. In jurisdictions where the government is effective at creating a fixed exchange rate between Bitcoin and their currency, then their currency could survive. In jurisdictions where governments are unable to do that, and you have a free floating exchange rate, then I don't see how their currency can survive, just based on the dynamics of monetary economics. And that's what we've seen with the US dollar, for example. So foreign governments that are effective at stabilizing their currency versus the dollar, their currency sticks around. For governments that are not effective at doing that, their economy experiences what's called dollarization, where US dollars are imported into their local economy and they circulate as money instead of the government's currency. And this has happened in a number of different jurisdictions. And so I would expect that to be the same with Bitcoin, amplified by the fact that you have to look at the distance between the credibility of the local currency versus the credibility of the foreign currency. So in our example, whether it's the dollar or Bitcoin. And what we see is that investors arbitrage that, right? That's what what speculative attacks and carry trades are between currencies. And that's how the discipline of central banks is maintained in the current dollar system. And my thesis is that that's how it will be maintained in the future Bitcoin system. Now, what does it mean for it to be a reserve currency? I think it starts on an individual level. Individuals today are using Bitcoin as their reserve currency in the sense of they're using it for long-term savings. If you've held Bitcoin longer than 4 years, you've never been down. So it's kind of, that I would say is the minimum holding period for Bitcoin. If you're going to need money before 4 years, like hold that in cash,
I think it should be longer than 4 years, but I hear what you're saying.
Like, yeah.
Oh, a little dissension here with the first couple of Bitcoin.
Yeah. Okay. But, I agree in the sense that you should be thinking about it, with a 50-year or 1,000-year mindset and thinking long-term.
At least.
Yeah, we're all going to live 1,000 years with the new technology, so that's okay.
And so it starts with individuals using it as their reserve currency. And now, as Morgan mentioned earlier, corporates are starting to use it as their reserve currency. And I think that eventually governments will as well.
Okay. Yeah. So yeah, like Morgan said, we had MicroStrategy that came out and said, we're going to use that as on our balance sheet. And then Square bought, I think, 50 million to put on their balance sheet. And I think other companies are doing it. So what I'm hearing you say is that probably there's going to be some country that's going to get the headline and said, we're going to put Bitcoin on our central bank balance sheet. And then that might be, we need the first mover there. And then when that happens, just like MicroStrategy was for the corporate world, maybe there'll be some country that'll do it for their central bank and start the movement there.
Do it here, right? I mean, it would be great I think that's kind of the thing that people don't really think about. It would actually be really great for America as a whole.
To lead, yeah.
Yeah, if we had it on our balance sheet, think about like how they could actually help people if they weren't constantly trying to bail them out with these random monetary programs that don't work.
Right.
And they actually were holding an asset that incentivized the government to save and the government to think wisely about which programs they actually want to fund.
Yeah. So I want to ask both of you this question. I'm going to start with you, Morgan. And the question is this move to Bitcoin as a world reserve currency ultimately, is it probable or do you think it's inevitable?
Oh, that's a great question. I mean, I believe it's inevitable. I don't know how long it will take.
Okay.
And my hope is, especially we have young kids. Like my hope is that it's soon enough that they get to experience this in their lifetime. I mean, your hope is always that the next generation is better off than you were. And that it happens in a short enough period of time that not only maybe do we get to experience it, but also that we know our children and grandchildren will as well. That would be obviously my greatest hope. I'm not sure how long it will take.
Mm-hmm.
Yeah, I agree that I don't know how long it'll take. I do think that when it happens, it'll be like a switch getting flipped. And I would draw the parallel to March of last year, when there was a switch flipped where people went from not caring about COVID and saying, oh, it's just the flu, to switching to, oh, this is like the worst thing that's ever happened to humanity. And that happened in like 1 week, right? Yeah. And so sentiment can change very quickly. And I really think that, on the point of the government holding Bitcoin, today the federal government holds $2 billion worth of Bitcoin. They acquired those Bitcoin by seizing it as part of a criminal investigation and currently they are planning to auction it off. I'm working on a bill in the House of Representatives called the Bitcoin HODL Act, which would stop this auction. And that's it. That's all I want to do. I just want to stop this auction. And we'll see, because I really
think you're not going to add 7,000 pages of garbage to your bill.
Yeah. Keep it simple. Keep it simple.
It's the world's shortest bill. It's
That's
not
right.
like
Yeah. Hodl.
Yeah. Because I really think that the incentives of Bitcoin apply to individuals, they apply to corporations, and they apply to governments as well. And so if we get into a mindset of having budget surpluses instead of budget deficits, then that will mean that we'll be more robust for the next crisis, right? We'll have the resources to take care of folks instead of having to borrow from our children and sticking them with the bill. It's irresponsible, but more than that, I actually think it's profoundly immoral, the current system and the way that it's transferring wealth to us from future generations.
Yeah, I wanted to add something though too to the conversation, which is that people tend to think that if monetary systems change, that they'll continue to change. And this is something that we were talking about just at dinner one night, is that like if we do actually move to something like Bitcoin as the world's reserve currency, people are going to have this expectation that maybe, oh, now we just like changed monetary policies all the time, and therefore Bitcoin maybe isn't the thing, and I can now hold a bunch of other crypto assets in the hopes that it'll change again. And these things tend to be long-term cycles that take a very long time. I mean, even getting to where we are today in the current fiat monetary system and modern monetary theory, it took a very long time, right? Governments weren't always printing at the rate at which they're currently printing. And when Bitcoin becomes a thing, I do think that our brains are going to be a little messed up. We're going to think to ourselves, oh, this kind of stuff can happen to us all the time, and therefore I need to kind of hedge my bets. And yet like changes to the monetary system actually take typically a very, very long time.
Centuries.
Yeah, centuries, really.
Yeah. So Morgan, let's talk about from a financial advisor standpoint. You've been advising on Bitcoin for your clients for a number of years now. We're starting to see some movement in the industry in terms of advisors being more receptive to this and more infrastructure being built around it so that advisors can provide guidance on this and perhaps even get paid for advising on it. So how do you see this evolving? And as a financial advisor yourself, what advice do you have for advisors listening here in terms of what they should be doing and thinking about as it relates to Bitcoin?
Yeah, I mean, the first thing that any advisor has to do is educate themselves. So I imagine every advisor is getting numbers and thousands of questions about Bitcoin from their clients. If they're not, then I don't know what world their clients are living in, but people generally get excited about things going up in price, right? And they want to talk about it. Whether it be, just a stock like Tesla that has, I don't know how much it's gone up in value, but it's done very well. Versus or something like Bitcoin, right? People ask about these things and they want to know whether or not it's something they're supposed to own. And when we as advisors don't know what it is, or we just think to ourselves, well, Warren Buffett said a long time ago that it's worthless, so I don't need to think about it.
Rat poison squared.
Yeah, exactly. Or it's not backed by anything, I don't know what this is. Don't even think about it. Move on with your life, right? Like if a client is coming to you with a serious question, even if you don't think it's serious, for whatever reason, it is serious to them. So when you don't take it seriously, they don't think of you as taking them seriously, right? They leave that meeting thinking to themselves, maybe this person isn't right for me. And if you do that enough times, they leave. They find somebody else who will actually answer their questions. So even if you don't think that Bitcoin is going to be a thing, you should at least educate yourself on it so that you can have a good, like a well-informed discussion with your client about it when they do come to you with the question, as opposed to just being like, my compliance won't let me do that.
Yeah. So if you have an advisor and they say, yeah, this is a thing, I think Bitcoin is here to stay, maybe it's going to become the reserve currency. How do you view Bitcoin then in the context of a client's balance sheet or portfolio? Do you view it as this is the cash piece, and so we want to have 6 months worth of cash in Bitcoin? Or do you view it as an asset like an equity, or an asset class and say, well, we're going to allocate 10% to this asset class called Bitcoin? How do you think of it in that context?
Yeah, that's a great question. I think you have to take that on a client by client basis. We tend to view it as an asset in my business just because we still live in a fiat world. Clients still have to keep cash around to meet their day-to-day needs, right? So especially in my practice where I have a lot of clients, they get paid fairly irregularly. We tend to actually hold more cash in my business and have that cash drag that is unfortunate, but necessary given how some of my clients operate. Either they're business owners where they don't get paid for 3-4 months at a time, and then they get a large chunk of money, or they're a very high paid professional where the majority of their money comes in the form of a bonus, and we're allocating that bonus out and making sure that we have enough cash for the entire year. So if I were to say to that client, hey, now let's use Bitcoin as your reserve. And then we happen to go through a Bitcoin bear market, right? That's not really going to reflect that well on what the client needs. But for other clients who are getting, like, if you get paid very regularly and there's really a lot of, there's not that much uncertainty in your cash flows, you can hold a lot less cash, right, as your reserve. And then you can maybe hold a larger percentage of your assets in riskier assets. And that's typically how we look at risk tolerance in my practice. So it's a function of how somebody reacts to prices going up and down, and how much they'll, what's the probability that they're actually going to need that money. And when we think about the probability of them needing the money, it's usually more related to their goals because we've already sorted out the cash portion of it. I think at some point it will switch to a place where if really Bitcoin does become a world reserve currency, right, we hopefully don't have to keep that fiat around anymore, and we'll be able to actually hold Bitcoin on a client's balance sheet as the cash reserve. But for now, I don't think that typically makes sense. And then you have to look at it on a case by case basis. So for some clients, it really doesn't make sense for them to hold that much in bonds, right? And we're kind of in this place right now where their risk tolerance is high enough. They're not going to need that cash for a long period of time. And therefore, yeah, we can take a little from bonds and move it into Bitcoin. For other people who, they don't sleep well at night if their portfolio goes up and down like crazy, it's not really the best bet to take some money out of bonds there if they're not going to be able to hold on to their Bitcoin position for a long period of time. So in that case, you just have to gauge it client by client. That unfortunately leads to more bespoke portfolios. But in my practice, I mean, that's how we do it. And that's how I would suggest anybody do it, because you always have to put the client first, right? And not use the model just because you have a model.
Okay. And I think what I heard you say, and this is a good point, is if I'm going to allocate 2% or 5% or 30% to Bitcoin, that's going to have to come from some other part of the portfolio. And I think I heard you say maybe for some clients, maybe it comes out of the bond piece. Maybe for other clients, it comes out of the equity piece, or maybe it comes out of the private equity piece, because they view this as a very speculative investment. So instead of going to private equity, I'm going to put it in Bitcoin and kind of consider that my speculative part of the portfolio. So is that what I heard you basically say?
Absolutely correct. And you really need to evaluate it on a case by case basis. So
Right.
I would say, if you know that a client is risk averse, you have no business taking any of their money out of bonds and putting it into something like Bitcoin. If you have a client who's relatively, they have a large risk appetite, they understand what you're talking about, they're excited about it, they want to be a part of it, then by all means take from a less risky bucket. Because I mean, I'm sort of in the position right now where I feel like, because of what governments are doing, bonds are riskier than stocks to me. But that I know that not everybody feels that way, right? And not everybody has the kind of risk tolerance that I have. Not everyone is, starting a business at the age of 28 and kind of flying by the seat of my pants, doing, not even really keeping that much cash around. And I feel comfortable doing that, but I know a lot of people don't feel as comfortable doing that. And there are limits, obviously, to my risk tolerance too. I like to keep a certain amount of fiat cash around, and I don't feel comfortable if I don't have certain numbers. And that's exactly why when you're talking to a client, you need to know that as well as you know it for yourself.
And then what needs to be further developed in the financial industry for financial advisors to be able to just as easily say, we're going to put 2% in Bitcoin as I allocate 2% to Apple? What are you hearing or seeing in terms of the infrastructure that's becoming available now to make it easier for advisors to do this?
Yeah, so I mean, you can do it right now, right? There's something called GBTC. It's a private placement that now trades on the public markets, basically the closed-end fund. It typically trades at a premium. There's no reason why you couldn't help your client buy that right now, unless for whatever reason your compliance is blocking you from doing that. If you custody over Fidelity, you can actually have your client buy into Bitcoin rather than buying into the closed-end fund style of Bitcoin. You can also talk to your clients and see
how interested they are in this and how much they're willing to do to get Bitcoin. So some of my clients hold GBTC, some of my clients actually hold their private keys. And it's just more of a function of like a client's risk tolerance, their ability to keep track of it, how like, you know, how responsible are they going to be with their private keys, depends on where we keep our Bitcoin, and how involved they really want to be. And there's kind of no reason, I don't think, I mean, Bitcoin was said, I mean, it's been said by the SEC that it's not a security. So you don't really need permission to help a client go open an account at Coinbase or Kraken or Gemini and go buy, you know, to help them go buy Bitcoin on their behalf, even if you can't, let's say, buy GBTC in your practice. Yeah, there's an extra step there. Yes, it'll be a longer meeting. Yeah, it probably doesn't fit into your normal schedule. But you're doing the right thing for your client. And at the end of the day, that's why we're here, right? We're here to make sure that our clients have good and like successful financial outcomes. So in my mind, like, we're at the beginning of this, and why wouldn't you want to be somebody running in the forefront trying to help your clients at like be really at the beginning of something amazing, as opposed to being the person who, you know, when Bitcoin is $500,000 a coin down the road, that you're like, you missed it. Sorry.
It's too late. It's too late at 40,000, right? How many times have we heard that too? It's too late at 10,000. It's too late at 5,000.
And if you don't feel like if you don't feel that comfortable, right? Like, I know you don't like when I say this, but like a 1% position is not going to make or break your client, right? And I know that's what we've talked about this, and Pierre said, well, that's what scammers say. Well, it's only 1%.
Yeah,
but, no, I mean, in the context of this, though, it actually makes sense. You get your feet wet, and then you get a little bit more excited about it. And then maybe you help your client buy a little bit of GBTC, but then they get excited about it and they want to go open an account somewhere. And then now they're actually holding their private keys. So it's like whatever you can get them to do to get their feet in the water is what you need to do.
Anything to add to that, Pierre?
Yeah, so I think on the first part about the way to think about Bitcoin and cash versus investments, I think about it as there's short-term cash, which is like fiat and USD, and then there's long-term cash, which is Bitcoin. And so long-term cash, like you want to have an expected duration of 4 to 10 years, or longer, right? But at minimum 4 to 10 years. And then separately you have your investments. And the reason I draw that distinction is because there's you know, from an advisor perspective, I think that distinction doesn't really matter, right? Because investments are long-term. But from an economics perspective, there is a difference between investing in a business or lending money to a government versus holding money, right? So one is saving and the other is investing. And I think it's really important that we start drawing that distinction again, because we lost that distinction in the fiat world, where we don't like saving anymore, right? With cash or with fiat cash. And so, you know, it's kind of got a negative connotation to it of you're just like hoarding money like a crazy person. In Bitcoin, the incentives are different. And so that's why we've seen this HODL meme appear, right? Or HODL, as some people pronounce it, where there's an emphasis on actually holding Bitcoin and not going out and investing or not going out and consuming. And so that's the distinction I would draw of short-term versus long-term cash. And then in terms of position sizing, you know, I agree that for folks who are risk averse, you don't want to throw them into this high volatility market. I would add, though, that for folks who are maybe on the you know, high net worth to ultra high net worth part of the spectrum, there's options and futures that are available. So there are derivatives products on Bitcoin that you can use if you want to, for example, hold your own private keys, hold your Bitcoin. You like that part of being, you know, self-sovereign and independent and not having to trust a bank or having to trust the government, but you want to protect your downside. You can use derivatives to do that. And so, you know, you'll pay obviously the insurance premiums on that, but it allows you to mitigate your risk while also benefiting from Bitcoin's fundamental properties.
Yeah, and I know we're bumping up against time here, but I do want to ask you, what could go wrong? And I'm not talking about it's a Ponzi scheme. I mean, I think we're beyond that piece, but is there something that we don't see today that could be fundamentally wrong with Bitcoin, or maybe it's a regulatory thing? Is there anything out there that you could imagine that would say, oh my gosh, we got Bitcoin all wrong, we're screwed?
Yes, yes, there is, absolutely. And so what I tell folks is that, to me, Bitcoin is the least uncertain system. That doesn't mean that it is certain, right? And so what I mean by that is that there might be a bug in the Bitcoin software that causes a problem, right? And we don't know what that bug is. It's something we know that we don't know. Um, or, for example, there might be, for example, Satoshi holds a lot of Bitcoin. What if he goes out into the market and just market sells all of his Bitcoin and causes the price to dump?
That was one thing I was thinking too. And nobody talks about that, but it's like maybe Satoshi's still alive, and maybe when it hits 100,000, I mean, who knows? But that people don't talk about that much.
Yeah.
Yeah.
And so these are fundamental uncertainties about Bitcoin. What I would argue is that they are less impactful than uncertainties in other asset classes, right? So, for example, when we talk about Satoshi dumping his coins, the parallel in the fiat system would be, well, what if central banks print a bunch of money? Okay, well, that's already happening.
Yeah.
So we can already, it's already priced in, or, it's already a problem being realized. Or in the gold market, central banks hold massive amounts of gold in their reserves. What if central banks decide to sell gold, right? It could cause...
Or Musk was able to mine gold from an asteroid.
Exactly, yeah. So that's more science fiction-y than central banks selling gold, but that's a good point. I agree. Or some kind of technological improvement that makes it very economical to mine more gold, right? And so these are things that are like uncertainties about other asset classes that I would argue that are greater than Bitcoin's uncertainties. And at this point, Bitcoin's been around for 12 years, so the software has been in production for 12 years, and there have been bugs in the past, right? And they've gotten fixed, and the system continues to function today. And so I think that another part of what makes Bitcoin interesting is that it's open source. And so all of the software's code is publicly available on the internet. And so you can go to github.com/Bitcoin/Bitcoin. If you know C++, you can read it, from first principles. You can check everything yourself and see how it works. And many people have done that. And many hackers have done that, right? Trying to find vulnerabilities in the system that they could exploit. And so far, it has proven itself to be secure. The problem with Bitcoin is the private keys, right? And this is where there's a huge amount of uncertainty, and uncertainties that have caused harm to people, right? In a variety of ways. One is they lose their private keys. There's a fire, your private keys get destroyed. Okay, so there's mitigations, right? You could use multi-sig so that you can split up your private keys in different physical locations so that you can avoid, the risk of fire. There's been theft, right? So famously, an exchange called Mt. Gox was hacked, and people lost their Bitcoin there. So theft is a concern. Thankfully, since Mt. Gox, we've seen more emphasis on security at exchanges, and so hacks of exchanges have become less and less frequent. And then on the individual side, the use of hardware wallets has also reduced kind of the problems of holding your own private keys. And we've seen custodians come in like Fidelity that are institutional grade custodians, where you don't have to worry about the private keys because Fidelity is going to take care of it for you. And so that's kind of where uncertainty still exists. Obviously, you can't get it down to zero, but it has rapidly improved over the 12 years of Bitcoin being around. And there's a third one that doesn't really get talked about as much, is transaction fees. So to use Bitcoin, to send Bitcoin around, you have to pay transaction fees. And these transaction fees it's a decentralized marketplace. So there's not a centralized authority that's determining what the transaction fees are. Instead, it's determined by how much usage of the network is there. And when there's a lot of congestion on the network and a lot of people are trying to send transactions, it causes transaction fees to get bid up. And so there is a risk of you're using Bitcoin and one day it costs you, a nickel to send Bitcoin. And the next day it costs you $50 worth of Bitcoin to send Bitcoin. And so there's been this historical volatility of network congestion based on what's going on with the Bitcoin price, et cetera. And so that's also an area of uncertainty. But at the end of the day, we haven't really seen Bitcoin transaction fees get any higher than what it costs to send a wire transfer. So I think there's kind of a psychological ceiling where people will just wait to send Bitcoin until the fees come back down. But that's also something to be mindful of and that, you might hear about from different folks.
Yeah. So not risk-free, but less risky than perhaps the alternatives that we have here today, is what I hear you saying.
Yeah, that's right. And so, with the transaction fees, okay, so maybe you'll have to wait to send your Bitcoin. In the fiat system, maybe your bank account gets frozen, right? And so we've seen this happen, for example, in Argentina. If you had a dollar bank account, the Argentinian government froze it and took your dollars. We recently, just this past week, it happened in Cuba. Cuba had, a sound money that they were doing within their banking system. And sure enough, when the government actually needed those resources, they froze everyone's Cuban dollar bank accounts, and now you can't access that money anymore. And so there's just much greater fundamental uncertainties in all of the other systems than in Bitcoin.
Yeah, well, there's so many more topics I'd love to talk to you two about, but I think we'll probably have to wrap it up here. So let's just do one final thing here. Start with you, Pierre, is tell me, what are you doing right now? And what's the best place or way for people to stay up with all the great stuff? I know you're on Twitter, putting a lot of great content out on Twitter, but what is it that you do day to day? And what's the best ways for people to stay in touch with what you're doing?
Well, day to day, I help my lovely wife. So I'm a husband and father first and foremost.
And
a good one.
Yeah, you're a good husband and father.
Oh, thank you. Thank you. I try my best. And I work at Kraken. Kraken is one of the world's leading Bitcoin exchanges. And it's, the #1 exchange in Europe, #2, but rapidly growing in the US as well. And so I help with all things related to Bitcoin there. Kind of their Bitcoin subject matter expert, although there's many others there, obviously. And right now we're working on integrating with what's called the Lightning Network. And we didn't have time to talk about the Lightning Network today, but it's a new protocol that leverages Bitcoin's blockchain to create instant and cheap payments that we might be using at for example, Starbucks in the future, right? And yes, you can find me on Twitter at Pierre_Rochard. In terms of finding other folks on Twitter, one website that I highly recommend is called hive.one, HIVE.one, ONE. And this website provides an algorithmic ranking of who are the most influential Bitcoin Twitter accounts. So there's no subjective favoritism. It's literally just algorithmically who is the most influential. And so I highly recommend following, the top 500 there.
There you go.
It takes a while to do, but it'll give you a lot of different perspectives on Bitcoin. I have my own opinions on Bitcoin. There's a lot of different views out there, and I think people should listen to all of them and evaluate them on their merits. And so, yeah, I'll leave it at that.
Yeah, I'd never heard of that website, hive.one. So I just pulled it up here, and #1 is Adam Back. So Adam is one of the creators of a key piece of the Bitcoin software. So he goes back decades here in the development of cryptography and all that. Peter Woolley. I don't know who Peter is.
So I'll make a shout out to Peter. He is one of the foremost protocol developers for Bitcoin. And so he has helped with significant upgrades to the Bitcoin protocol. Upcoming is an upgrade called Taproot. And this is about improving Bitcoin scripting language so that we can do all sorts of really cool automated business logic with Bitcoin. And I'm really excited about what he's working on. And he is hugely influential within the technical community within Bitcoin.
And also, I feel like we should get an updated Peter Woolley calendar.
Oh, yeah. And so Adam Back is the CEO of Blockstream. And a while back, he sent me a calendar that had pictures of Peter for each month, or drawings of him. And yeah, anyway, inside baseball there.
Yeah, there you go. And I see number 6 here is someone I recognize, some guy named Pierre wearing a cowboy hat. Nice branding. All right, Morgan, how about you? We know you're an advisor, but what's the best way for folks to stay in touch with what you're doing?
Yeah, so my registered investment advisor is Origin Wealth Advisors. That's originwa.com. You can find me there. I also have another business called Money Owners that provides financial coaching and also has a podcast. Pierre and I actually did a podcast together, I guess about a month ago now. So you can listen to that too. If you liked what you heard here, then you can get a little bit more there. And that's moneyowners.com. You can also schedule a call with me for consulting. I offer both advisor consulting and really, yeah, I mean, consulting for regular people on financial concerns. But the thing that I've seen that's been growing the most is actually advisor consulting. People want to know what I'm doing in my practice, how I'm doing it. They want to pick my brain. You want to pick my brain? Great. Go to my website.
Pay me, and preferably in Bitcoin.
Yeah, exactly. Happy to do it. I'm super happy to do it for you and help you out as best as I can. I don't offer coaching packages or anything like that, but for the people who just want to, dig in there for a couple of hours, then, by all means. And then, yeah, you can find me on Twitter at Morgan with an E Rochard.
Yeah. And you have a book too, right?
Yes, I do. Thank you for reminding me. I wrote a book. I wrote a book called the Personal Finance Quick Start Guide. You can find it on Amazon, and it's through Clydebank Media Publishing. And there is a section on Bitcoin in there. And the thing that I've been trying to promote for advisors is that Bitcoin doesn't make us obsolete. Bitcoin makes us more important. And Bitcoin actually makes financial planning in general more important. So if you're somebody who's really interested in Bitcoin and you think that you don't need to do any financial planning, I tend to disagree with you there. And you could really read my book and view it through the frame of how you're going to apply it to your Bitcoin rather than fiat, which is what it's currently written in, just because of the current environment we live in.
Excellent. All right. Well, hey, Morgan, Pierre, appreciate you guys being on the show. This is fantastic. And congratulations on the upcoming child here, addition to the family, and just all the great work you two are doing.
Great. Thanks, Steve. Thanks for having us on. These were great questions.
Yeah, thank you. We had a great time.